Bonds and stocks are two of the most common types of investment securities available in the financial markets. A bond is a debt security issued by a company, government, or other organization where the issuer agrees to pay the holder of the bond a fixed interest rate for a specified period of time and then repay the principal amount at maturity. A stock, on the other hand, represent ownership in a company, giving the shareholder a claim on the company's assets and earnings. Valuation is the process of determining the intrinsic value of a financial asset, which is the estimated worth of the security based on its expected future cash flows. In the case of bonds, valuation typically involves calculating the present value of the expected interest payments and the principal repayment using a discount rate that reflects the risk associated with the bond. In contrast, stock valuation involves assessing the company's financial statements, future growth potential, and overall market conditions to estimate its intrinsic value. Understanding the valuation of bonds and stocks is essential for investors to make informed investment decisions and to manage their portfolio effectively. A thorough understanding of the factors that affect the value of these securities can help investors determine the appropriate level of risk and return for their investment goals and can assist in identifying opportunities for long term growth and income. At this point, I'm going to discuss to you guys the bonds. What are the advantages and disadvantages of the bonds, the effect of bonds on the economy, the valuation of bonds, where I'm going to show you the formula and examples on how to apply it, and then also the yield measures types, which are the yield to maturity or what we call the YTM, or yield to call YTC, and then the current yield. Okay, so what is bonds? So bonds are a type of debt security that represent a loan made by an investor to a borrower. So typically a corporation or government entity. So when an investor purchases a bond, they are essentially lending money to the borrower who agrees to pay back the principal amount plus interest over a specified period of time. So what are the advantages of bonds? And that include number one, it it's a good source of income, a regular source of income, because the bondholder receive fixed interest payments, and usually they can opt to semi-annually. Sometimes they can also select like annually, which provides a regular income stream. It is less risky than stocks. So bonds are generally considered to be less risky because they have a fixed rate of return and a predetermined repayment schedule. Another is diversification. So bonds can be used to diversify a portfolio, providing a more stable foundation than stocks. And credit rating. So bonds are rated by credit agencies, which can help investors evaluate the risk of investing in a particular bond. However, there's also disadvantages of bond, and that includes one, lower potential return. So while bonds are generally considered to be less risky than stocks, they also offer lower potential returns. Number two, interest rate risk. So bonds are sensitive to changes in interest rates, which can cause their market value to fluctuate. Third, inflation risk. If inflation rises, the fixed interest payments on a bond may not keep up with the increased cost of living. And number four, credit risk. If the borrower defaults on the bond, I'm sorry to tell, the investor may not receive their full principal amount or interest payments. And that those are the advantages and disadvantages of bonds. And then this time, let us discuss about the effects of bonds in the economy. So bonds play an important role in the economy by providing a source of financing for corporations and governments to fund their project and operations. So the impact of bonds on the economy can be seen in the following ways. One is for the capital formation, where bonds enable corporations and governments to raise capital that can be used for investments in new projects, expansion, or to fund fund ongoing operations. And this promotes economic growth by increasing the availability of funds for investment. Another is interest rates. So the supply and demands for bonds can influence interest rates in the economy. So when there is a high demand for bonds, it can lead to lower interest rates, making it cheaper for businesses and individuals to borrow money. Conversely, when there is a low demand for bonds, interest rates may increase, making borrowing more expensive. The next one is financial market stability. So, bonds can provide stability to the financial markets by offering a fixed rate of return and a predictable repayment schedule. So, this can reduce volatility and uncertainty in financial markets. And lastly, government borrowing. So governments often use bonds to finance their operation and fund public projects. So when governments borrow money through bonds, it can increase the national debt, which can have both positive and negative effects on the economy. So overall, bonds serve as an important tool for financing in the economy and can have a significant impact on interest rates, financial market stability, and economic growth. At this time, let us discuss about the valuation of bond. So, valuation of bond refers to the process of determining the present value of future cash flows generated by a bond. So, the value of a bond is the sum of the present value of its future interest payments and the present value of its face value, or what we call the principal payment. So the formula for valuing a bond is the bond value is equal to the present value of coupon payments plus present value of face value payment. And to calculate the present value of the coupon payments, you need to use the following formula. So present value of coupon payments is equal to coupon payments divided by, inside the parenthesis is 1 plus yield to maturity to the n power. So where coupon payment is the annual interest payment, yield to maturity is the market interest rate for the bond, and the N is the number of years until the coupon payment is received. So to calculate the present value of the face value payment, you need to use the following formula. So present value of face value payment is equal to the face value divided by, inside the parenthesis is 1 plus yield to maturity to the n power, where face value is the amount of the bond's principal, yield to maturity is the market interest rate for the bond, and the n is the number of years until the face value payment is received. And then this time, let us apply the formula for valuing a bond. For example, suppose you have a bond with a face value of $1,000, an annual coupon rate of 5%, and a maturity of 5 years. So if the current market interest rate is 4%, you can calculate the value of the bond as follow. So first, calculate the present value of the coupon payments for each year. For example, in year one, it will be like $50, the worth of the coupon, divided by, inside the parenthesis is 1 plus 4% to the power of 1. So, which means that from your $50, so you're going to receive 48.08 dollars. And then year two, $50 divided by 1 plus 4% to the power of 2, so that will gives you a $46.29. And then year three, $50 divided by, inside the parenthesis is 1 plus 4% to the power of 3 will give you $44.60. Year 4, $50 divided by, inside the parenthesis is 1 plus 4% to the power of 4 will give you $43.01. And then for the fifth year, $50 divided by, inside the parenthesis is 1 plus 4% to the power of 5. That will give you 41.51%. So the next one is to calculate the present value of the face value payment, which is 1,000 divided by, inside the parenthesis is 1 plus 4% to the power of 5. That will give you $820.08. So finally, add up the present values of the coupon payments and the face value payment to get the value of the bond. So the bond value is equal to $48.08 plus $46.29 plus $44.60 plus $43.01 plus $41.51 plus $820.08, and that will give you $1,043.57. Therefore, the value of the bond is $1,043.57, which is greater than its face value of 1,000 because the market interest rate is lower than the bond's coupon rate. So, as you can see, that the value of the bond is higher than its face value because the coupon rate is higher than the current market interest rate, so making the bond more attractive to investors. Okay, so now I'm on my final topic about bonds, and those are the three types of yield measures that investors can use to evaluate bond investment. One of that is the yield to maturity, and the YTM is the return if held until maturity. YTC is the return if held until the call date, and the current yield is the annual return based on the current market price. So they provide different information and are useful in different situations. So there is no better yield measure as it depends on the investor's needs and preferences. So usually the YTM and the YTC, so they are more comprehensive measures to take into account the bond's inter cash flows, while current yield is a simpler measure that only looks at the bond's current income stream. So investors may choose to use one or more yield measures depending on their investment goals and the characteristics of the bonds they are considering. And that is my report. Thank you so much for paying attention. And hopefully, I didn't put you to sleep because I know that is my special power. So I'm going to give you my partner, Mrs. Rivera, to discuss about stocks. Ms. Rivera, it's your turn. Thank you.
Thank you, Marianne Palencia, for your excellent explanation of bonds. Our next topic is stocks. We're going to be reviewing the advantages and disadvantages of stocks, the effects of stocks on the economy, the valuation of stocks, formulas, and examples, and some of the common stock valuation models, such as dividend discount method, DDM, discount cash flow method, DCF, and preferred stock valuation. Stocks or shares of ownership in a company offer investors the potential for long-term capital gains and dividends. However, there are also risks associated with investing in stocks. Here are some advantages and disadvantages of investing in stocks. Some of the advantages are potential for high returns because stocks provide higher returns than bonds or other fixed income investments, as the value of the stock can increase over time, resulting in capital gains. Diversification: investing in stocks can provide for an investor's portfolio. By investing in stocks of different companies in different industries, investors can spread their risk and potentially reduce the impact of market volatility. Ownership: owning shares of stocks means owning a part of the company, giving investors a voice in the company decisions through voting rights. And liquidity: stocks are generally more liquid than other investments, meaning they can be easily bought and sold. Some of the disadvantages are volatility. The value of the stock can be highly volatile, meaning they can fluctuate widely in value in a short period of time. This volatility can be influenced by market conditions, economic factors, and company specific news. Risk of loss: investing in stocks involves a risk of loss as the value of the stock can decrease well as increase. And lack of control: while owning stocks provides ownership in a company, investors have limited control over the company's operations and management decisions. And lastly, market timing. Timing the market can be difficult, and investors who buy and sell stocks at the wrong time may miss out on the potential gains or experience losses. Overall, investing in stocks can provide the potential for high returns and diversification, but also comes with volatility. It's important for the investors to do their research and consider their risk tolerance before investing in stocks. Effects of stocks in the economy. Stocks or equities play an important role in the economy by providing companies with a way to raise capital and by offering investors a means of participating in a company's growth and profitability. The impact of stocks on the economy can be seen in the following ways. Number one, capital formation. Stocks enable companies to raise capital by selling shares to investors. This capital can then be used to fund research and development, expand operations, or invest in new technologies leading to economic growth. Number two, job creation. As companies grow and expand, they often hire more workers, which can be a positive impact on employment and the overall economy. Number three, consumer confidence. Strong stock markets can increase consumer confidence, as rising stock prices may indicate a positive outlook for the economy and encourage consumers to spend more money. Number four, wealth creation. Investing in stocks can allow individuals to build wealth and achieve financial goals such as saving for retirement or funding a child's education. And number five, economic indicators. The stock market performance is often used as an indicator of the economy's overall health. A strong stock market can signal a robust economy, while a weak stock market may indicate economic uncertainty or recession. However, it is important to note that stock markets can also negatively affect the economy. Stock market crashes and volatility can lead to economic downturns, and excessive speculation or market manipulation can negatively affect the economy. Overall, stocks play an important role in the economy by providing companies with a way to raise capital and investors with a means of participating in a company's growth and profitability. The impact of stocks on the economy can be both positive and negative, depending on market conditions and other economic factors. Valuation of stocks. Valuation of stocks refers to the process of determining the intrinsic value of a stock by analyzing its financial performance and future growth prospects. There are several methods for valuing stocks, including the discounted cash flow method, the price to earnings ratio, price to sales ratio, and dividend discount model. One commonly used method for valuing stocks is the discounted cash flow method. The DCF method calculates the present value of the future cash flows that the investor expects to receive from the stock. You can see the formula here for the DCF model. In this formula, dividend payment is the expected dividend payment for each year. Discount rate is the investor's required rate for return. N is the number of years for which dividends are expected, and terminal value is the expected value at the end of the projection period. On this slide, you can see an example of valuing a stock. For example, suppose you want to value a stock that is expected to pay an annual dividend of $2 for the next 5 years, and the expected terminal value of the stock is $40. If the investor's required rate of return is 10%, you can calculate the value of the stock using the DCF method as follows. For year 1, the stock's value would be $1.82. For year 2, $1.65. For year 3, $1.50. For year 4, $1.37. And for year 5, $1.25. The terminal value would be $23.71. And the stock value at the end of the 5 years would be $31.30. Therefore, the value of the stock is $31.30, which is the present value of the expected future cash flows from the stock. If the current market price of the stock is lower than $31.30, it may be undervalued, and if it is higher than $31.30, it may be overvalued. Common stock valuation models. Stock valuation is a process of determining the intrinsic value of a stock by analyzing various factors that affect its price. Common stock valuation models are used by investors and analysts to estimate the fair value of a stock, which helps them make informed investment decisions. There are two broad categories of stock valuation models: absolute valuation models and relative valuation models. Absolute valuation models rely on a company's fundamental and future growth prospects to determine its intrinsic value. Here are some examples of absolute valuation models on common stock. Dividend discount method, DDM. The dividend discount model is a simple absolute valuation method that estimates the fair value of a stock by discounting its future dividend payments to its present value. The model assumes that the stock intrinsic value is the sum of all future dividends discounted back to the present. For example, suppose a company pays an annual dividend of $2 per share, and an investor's required rate of return is 10%. The fair value of the stock would be calculated as follows. Fair value equals annual dividend divided by required rate of return minus dividend growth rate. Therefore, according to the DDM, the stock is undervalued if its current market price is lower than $40 per share. Discounted cash flow method, DCF. The discounted cash flow method is a more complex absolute valuation method that estimates the fair value of a stock by projecting its future cash flows and discounting them back to the present value. The model assumes that the stock's intrinsic value is the sum of all future cash flows discounted back to the present. For example, suppose a company is expected to generate an annual free cash flow of $10 million for the next 5 years, and an investor's required rate of return is 12%. The fair value of the stock would be calculated as follows. Fair value equals free cash flow divided by 1 plus required rate of return to the end, and so on. So therefore, according to the DCF model, the stock is undervalued if the market price is lower than $33.47 million. Preferred stock valuation. Preferred stock valuation is a type of absolute valuation method that estimates the fair value of a preferred stock by calculating its present value based on the expected future dividend payments. Preferred stock valuation is similar to the DDM, but it uses a different dividend discount rate, which reflects the risk and return characteristics of the preferred stock. Here is an example of how preferred stock valuation works. Suppose Company A issues a preferred stock with a par value of $100, a dividend rate of 6%, and a maturity of 10 years. The market interest rate for similar security is currently 5%. The company pays dividends annually. To value the preferred stock using the preferred stock valuation method, we need to calculate the present value of its future dividend payments. Here's how to do it. Number 1, calculate the annual dividend payment by multiplying par value times dividend rate. Number 2, determine the discount rate. The discount rate is used in the preferred stock valuation method is the rate of return required by investors for investing in similar securities. In this case, the market interest rate for similar securities is 5%. Number 3, calculate the present value of the future dividend payments. Using the preferred stock valuation formula, we can calculate the present value of the preferred stock as follows. Annual dividend payments divided by discount rate. Therefore, the fair value of Company A's preferred stock is $120 per share. If the current market is higher than $120 per share, it may be overvalued. And if it's lower than $120 per share, it may be undervalued. Some considerations. While absolute valuation models provide a good starting point for stock analysis, they have some limitations. For example, these models rely on a variety of assumptions which may not hold in the future. Additionally, the accuracy of the model depends on the accuracy of the inputs, such as the growth rate and discount rate. Therefore, it is important to use multiple valuation models and consider qualitative factors such as management quality, industry trends, and competitive landscape when evaluating a stock.
Thank you so much, Ma'am Angie, for your very comprehensive report about stocks. And here is our group takeaways. A bond is a type of debt security issued by a company, municipality, or government entity to raise capital. Bondholders lend money to the issuer in exchange for periodic interest payments and the return on their principal investment at maturity. Bonds are generally considered less risky than stocks because they offer a fixed income stream and are typically backed by the issuer's assets of revenue stream. However, bonds also have disadvantages such as lower potential returns than stocks, inflation risk, and interest rate risk. There are different types of bonds such as corporate bonds, government bonds, municipal bonds, and international bonds, each with its own characteristics and risk. The valuation of bonds can be calculated using different yield measures, such as yield to maturity, yield to call, and current yield. And here are some key takes away from the stocks lesson. A stock, also known as a share or equity, represent ownership in a company. Stockholders can earn returns through capital appreciations, such as an increase in the stock price or dividends, like a share of the company's profits distributed to shareholders. Stocks are generally considered riskier than bonds because their return are not fixed and are subject to market volatility and economic conditions. However, stocks also offer higher potential returns than bonds and can be a good way to diversify an investment portfolio. There are different types of stocks, such as a common stocks, preferred stocks, and a growth stocks, each with its own characteristics and risk. The valuation of stocks can be calculated using different methods, such as the dividend discount method and discounted cash flow method. And for our final part of our report, think and share question. So if you have the opportunity to invest more money now or in the near future, so would you prefer to invest in stocks or bonds and why? So please type your answer in our Zoom chat box. Thank you so much, classmate, for your active participation, and thank you so much, Dr. Pineda, for this wonderful opportunity to learn about financial management. Yours truly, Marian Palencia, and Maria Angelica Rivera. Have a good day, classmate. Thank you.